Okay, great. So again, thank you everyone for attending. We are under contract on our first deal in Dallas, Texas, Riverbend Apartments. We're very, very excited about it. We have been trying to break into Dallas for about 2 years now. This is our first property. Don't penalize us for this being our first property. We were disciplined and we did not buy in late 20 and early and through 21 and through 22 when Dallas was very, very overpriced and very expensive. There has been a market adjustment, although not as much as a lot of other markets, because Dallas is still a phenomenal market. And here we are with our first acquisition that, again, we couldn't be more excited about it. We've underwritten over 100 deals this year in Dallas, and we've only been through about 6.5 months this year. We underwrote about 105 deals. So it's not for lack of effort that we're getting this first deal, but it's because of discipline. We watched the market as people were buying 2 and 3 caps and solving to a forward cap rate of 4 3/4, 4.5, more like 4.5, untrended. And that's just not something that we do. That's not a thesis that we believe in. And it looks like here we are being rewarded for not buying anything, because if we did buy a bunch of stuff, we probably wouldn't be having this webinar right now. And again, super excited about this because we got it at a 5.5 cap going in. We're solving to a 7 fully renovated. Not that that's the business plan, but that's what it looks like fully renovated. We'll be spending money on the deferred maintenance, doing a full common area reset, fixing up things like the fitness center, the rec rooms, the dog park, modernizing the asset, and doing about 20% of the units, and burning off the loss to lease, and then selling it to the next buyer in the next 3 to 5 years. Want to talk a little bit about Dallas and why we're so excited about it and why we haven't given up on the market, because it is just such a phenomenal market on its fundamentals. As we've talked to investors over the past couple months, one of the big objections has been, supply going into Dallas. Yes, but as we all know in economics, on the other side of supply is demand. And there is just a tremendous amount of demand in Dallas because of job growth, because of population growth. Companies are moving there. Local companies are expanding there. It is just an economic powerhouse. I actually love going to Dallas just to drive through it and see everything that's going on in Dallas. It's just amazing. When you put your eyes on it, you really understand it, as opposed to just reading something in the Wall Street Journal or online and looking at the data. You see the construction, you see all the industrial and everything that's going on in Dallas. And again, the city is just boomtown USA. So I'm going to go through a few of the fundamentals here in slide 1, and then I'll pass it off to the team to discuss the deal. Population, Dallas, 8 million residents, 1.2 million new residents since 2010, 170,000 since 2022, 2% growth. That's phenomenal. Dallas, as much as of an economic powerhouse as it is still relatively affordable. It's actually very affordable. And Texas, in my opinion, has the best housing policy in the country, better than anywhere else in the Sun Belt. It's just their approach to supply and adding supply has proven that there is no greater path to affordable housing than supply. Here you see the affordability, median household income is $84,000, and your average rents are just a hair over $1,500, which gives you a 4.6x income to rent ratio. That's phenomenal. And most large metropolitan cities would be very hard pressed to show that kind of affordability in this day and age. Build, baby, build, it truly is the best path to affordable housing. A few more metrics: 4.2 million total jobs, 150 new corporate headquarters since 2010. Some of them are very well known, such as Toyota, and then a lot of other large corporations that aren't necessarily household names and you haven't heard of. 3.2% year over year growth. And then on the rental side, on the housing side, they're continuing to get some growth over the last year, and 5.8% 10-year average annual rent growth, which is just amazing. I mean, that's like San Francisco type numbers over the past 25 plus years. Really, really strong rent growth. There's also, we just received, we being all of us, society just received 2022 census data, and Fort Worth is the #1 most moved to city in America. And as you know, Fort Worth is in the Dallas MSA, and the Dallas MSA increased by 170,000 people. Again, that's just amazing. And the country's highest numeric population increase. I've got an article here I could drop. I'm going to try to drop into the chat so everybody can access it, where it shows all that data. Next slide. Here it is, absorption. Again, anybody who's concerned with supply, it is absorbing very, very well because of the demand. And we don't see that demand stopping anytime soon. Dallas is one of the powerhouses of the Sun Belt of the US, and people will continue to move there for the jobs, the affordability, quality of life, everything. So again, super excited to be in Dallas, and we hope to scale to thousands of units in Dallas like many of the other Texas sponsors have done. Next slide. These are the handsome young men that are working on the deal, and this is where I'll pass it off to the team.
Hi, everybody. This is Andrew Lucas. I lead investor relations and capital raising here at Tryon. I'm going to do a couple slides, and I'll hand it over to Farhan. So you just heard from Max. Max is our co-founder and managing partner. Farhan is based in Los Angeles and is a partner who runs our West Coast acquisitions. And then this is the great unveiling of Oleg. He's a whiz kid. He's been with us about 3 years now, and he's really in the weeds on the underwriting and really knows the market and the deal extremely well. Next slide, please. So a couple housekeeping items real quick. This webinar is being recorded. So by registering, you will automatically get a recording probably within about 48 hours as soon as it's up on YouTube. We will begin accepting investments at the conclusion of the webinar. If you've already requested access to the data room, you'll receive an email basically now saying subscriptions are open. If you have not yet requested access to the data room, as soon as I'm done speaking, I'll post a link in the chat, and you will be able to, if you click that link, you just enter your name and email, and then you'll get an email granting you access to the data room, which will now have subscription documents. We're seeing a lot of demand for this deal. It's a large deal, but if you are interested, we recommend executing your documents just to make sure you secure your place. So we've been around since 2005. We have acquired, I believe it's 86 deals in total, and we've had 51 exits. On the exits that we've had, we've averaged internal rates of return to the investors of over 30%. So we've got a demonstrated track record of performing well in good economic times and in bad economic times. And in addition to offering direct investments, which we are offering here on this webinar, we also have, we offer a fund structure as well. So our third and fourth fund will both be investing in Riverbend. So if you are invested in one of those funds, the answer is yes, you'll have exposure to this deal. And then we're also currently accepting commitments to Fund 4. So if you like the concept of these investments, but you want a little more diversification, then the fund structure could potentially be a good fit for you. And we've had quite a bit of success since our company was founded. And one of the things that we've really done well is we've capitalized during periods when there's not as much buying demand in the marketplace. So, during the Great Recession from 2011 to 2014, we were extremely active, and we really took advantage of the lack of buyers in the marketplace. Then again, during COVID in 2020, so in April of 2020, after the world shut down, there were very few real estate companies aggressively trying to buy properties, and we were one of them. And in hindsight, that was a really good decision because every acquisition we had in 2020 is going to be a home run. And it kind of feels like there's a similar feeling out in the marketplace right now. There's none of the institutions, or not many of the institutions, are currently allocating money. So there's a lack of buyer pool in the marketplace. And you can see that, we've underwritten 100 deals and we're now entering this market, buying this asset at $117 a unit, which is an extremely favorable entry point. Next slide, please. So this, I know the next two slides won't present well on the webinar, but we wanted to include them because oftentimes people request the deck. This is our current portfolio. We currently own in 7 states, and Texas will be our 8th state. So we own it'll be over 6,000 units with this acquisition. And we also, something I want to point out, we are vertically integrated and we do self-manage all of our properties. So we have about 40 to 50 employees in the corporate offices, which are LA and Miami. And then we actually have Tryon employees at the properties, doing the property management, doing the leasing, doing the maintenance, and they're supported by our on this specific deal will be the LA-based office. Next slide, please. So this is our full track record, the 51 exits that we've had. You'll see there, I know the font's small. We've averaged project level IRRs of 38% and a 1.9x equity multiple over a 31-month hold period. So equity multiple, that's kind of the easiest way to quantify the return. So basically, on average, if you invested $100,000 in one of our deals, the project level return would have been $195,000. Next slide. And we're not promising or targeting those returns, on this deal or typically in general, but we do have a history of under promising and over delivering, and we're confident we'll continue to do so. So here's just the high level metrics of the acquisition. You'll see on this specific deal, we're targeting a 17% investor level IRR and then a 1.58 equity multiple on a 3-year hold. So again, what that equity multiple means is if you invest $100,000 and we hit our projections and timeline, when you tally up all of the distributions you will have received throughout the hold period, and then from the sale, it would equal $158,000. Your initial $100,000 investment, and then $58,000 in profit. So with that, I'm going to turn it over to Farhan. Farhan and Oleg are going to get into the real merits of this deal and why we feel so strongly about it.
Thank you so much, Andrew. Great job.
Thank you.
So I want to start by answering a question that is asked right now from time to time: is why do deals right now? And so to put it into context first, today when we close this deal, this will be our 2nd deal that we put under contract this year that we will close this year. Obviously, we did a lot more last year. I can tell you our acquisition team is making more offers, getting more offers denied than ever before. Our team is staying vigilant but patient. No question, we're seeing headwinds in the multifamily space, from increased supply to slower growth to expensive debt and an uncertain economy. We know we need to be careful. But ultimately, the answer to the why buy question right now is, for the first time in 13 years, we have motivated sellers and we have a lack of buyers. For the first time in a long time, buyers have pricing power. We can price deals that protect against the downside while also having a clear path to the upside. This deal, for instance, is a 5.4 going in cap rate. Over the last few years, you'd have to pay for a lot of the upside. When there was a deal with such clear upside like this deal, you'd have to pay for a lot of the upside. And it's not an exaggeration to say that this deal could have been a 4% cap rate, maybe even lower last year. Additionally, and maybe more importantly, we have almost 160 bips of untrended spread that can be added via a full renovation to a 7.04 yield on cost. That means without growth in the market, if the Dallas market grows 0%, if the Lancaster market grows 0%, you can add 30% value on execution of our renovation. That's fantastic, and we love to see that. Now, even with some of the added pricing power, deals that work on our numbers are definitely a needle in the haystack. I think Max and Andrew, and I think probably Oleg, but it was fun to look back at the numbers on how many deals we've looked at this year. In total, we've underwritten 106 properties in the Dallas market. And surprisingly, the average asking cap rate on those deals is a 4.4%. Again, we're going in at a 5.4%. And the average untrended return on cost on our numbers for those deals is a 5.14%. We're going in at a 7.04%. And the average price is $160 a door. And not a single one of those deals is touching an untrended 7% yield on cost that we're getting here. Now, if you've talked to me, you've talked to Max, Andrew, David, Oleg, anyone, you know that the untrended yield on cost figure is our North Star. Before we dig into a deal, before we put deals in a model, before we work hard on the deal, we have to make sure that we're adding enough value on renovation without any growth in the market. If that doesn't work, we don't pursue the deal. And it is very clear that that works very directly on this deal right here. So now at $117K a door, $133 per square foot, at a 5.4 cap in place, 7.04 return on cost untrended on full renovation, this deal is the needle in the haystack. And we're really, really excited to jump in. Now, reasons we're buying this deal. First, an off-market deal from a motivated seller willing to meet the market. I'm very proud to say over 80% of Trion's deals have been sourced off-market, and this one is no different. The seller was motivated enough to sell in this market, motivated enough to meet the market, and motivated enough to sell the deal off-market. Now, two, low-hanging fruit. We believe on our exterior renovation strategy and professional management practices, we'll be able to push rents immediately. And we think that is very clear. Oleg is going to kind of walk through the competitive rent set, but even post exterior renovation, we're still marking our classics to the lowest in the submarket. And so we think you'll think it's also very clear. The upside will be very clear as well. Now, three, as mentioned earlier, if there's one reason to buy this deal, one reason to invest in this deal, is this deal has strong basis and some of the best metrics we have seen, not only in this metro, but across the country in general, which is why we're excited about this deal and why you should ultimately be excited about this deal also. Now, four, the bones of this asset have what it takes to implement a renovation strategy that we have repeated and perfected. We are excited to bring the Tryon Reno to the Lancaster submarket, and we think it's going to perform very well. Now, last is the location. Max touched on, we think Dallas could be one of the best markets in the country, but we also like investing in workforce housing in industrial growth areas. We don't need the market growth here to make the deal work, but qualitatively, we like that it is there. And if there's any reason this deal will outperform, it could be that growth that we're talking about there. Now, first, I think anytime you're talking about a multifamily value add deal, the story of how the deal was acquired and who you're acquiring it from is maybe one of the most important. And so for those investors out there investing with other sponsors, I think that's a question you should ask maybe right at the beginning. So at Tryon, we pound the pavement pretty hard. We are in our markets often. We keep good relationships with brokers so we can have opportunities like this. For the brokers out there, you guys are our lifeline. We know that. We know that, and we absolutely appreciate that. And so we were able to source this through a broker relationship that Oleg from our team initiated. He's pounding the pavement, like I said, day in and day out. I'm super proud of him for finding this deal for us. And the seller here was motivated for two reasons. First reason, their loan, they got a variable rate loan, which we all know about, with an interest rate escrow that was eating up all their cash flow and potentially even pushing them into negative cash flow. Two, concurrently, the asset needed significant capital expenditure investment. So not only are they potentially bleeding cash, but they needed to invest additional CapEx dollars almost immediately. For an owner that is ultra focused on cash flow, you can understand why the seller would be motivated here. Now, this is the type of seller that is perfect for us. Their strategy is different, not bad, but different than ours, since they are typically long-term holders that prioritize cash flow to value creation. And they do so by minimizing CapEx, minimizing operating expenses, keeping rents low, usually trying to keep the occupancy high so that they can maximize cash flow. Our philosophy is a little bit different. We go in and almost immediately we invest in the weaknesses of the property, and so that we can cure those issues so that on the back end, buyers will not see those issues as weaknesses and will be able to sell to the exit buyer. Now, additionally, we're increasing kind of expenses all over the board here. We run a full expense load, which is different than maybe some other people may tell you, but especially when it comes to payroll, we need those boots on the ground executing the business plan so we can force appreciation quickly. Now, this deal clearly has some low-hanging fruit. I'm gonna introduce my colleague Oleg Anek, my colleague and friend, who may be one of the hardest working people in real estate, working 7 days a week. And I'm excited for you to meet him as he goes through the rental comp set and shows the low-hanging fruit at this property.
Thanks, Farhan. So yeah, what exactly do we mean by the low-hanging fruit? So 100% of the units of this property are in classic condition. And what that means is they haven't been touched, have not been renovated. And like we already mentioned, in the past 2 to 3 years, and this year alone, we have analyzed 106 deals. We have not seen a lot of properties that have 100% of the units that are in classic condition. But we've seen even less properties that have that much upside on their classic units. So at this property, on average, there's $150 per unit upside on taking your unrenovated rents and then bringing up to market. So what that means is that, let's say a tenant moves out of a classic unit, we can on average raise that rent by $150 by not renovating that unit. Now, if you take a look at the slide, here are some of the properties in the area. As you can see that on their classic units, they're charging $50 to $75 higher than our pro forma rents on unrenovated units. And as you can see, also oftentimes smaller unit sizes. So what's really compelling is that not only we have $150 in upside on our classic rents and bringing them up to market, but we're also going to be one of the cheapest rents in the market while having the potential to be one of the best properties in the area. Next slide, please. And now, in addition to that $150 upside by taking your classic units up to market, there's an additional $200 upside on your renovated rents. So as you can see again, here are some properties in the market. They're asking $75 to $100 higher than us. Again, oftentimes smaller unit sizes. So, you know, that's pretty compelling data right here. And I do want to point out one property right here on this comp set, just to make sure, you know, everybody understands. So Rolling Hills, the property at the bottom, they're doing a partial renovation scope. So unlike Pleasant Creek, Ventura Landing, and then soon to be Riverbend, where we're going to be doing a full renovation scope, they're doing a lower tier partial renovation scope, while at the same time, as you can see, they're asking pretty much our pro forma rent. So we feel very comfortable with these rents. Like Farhan mentioned, we stay conservative with our underwriting, and you know, one of those factors being pro forma rents. So as a summary, low-hanging fruit, feel really good about our classic rents, one of the cheapest in the submarket, $150 upside, and then a $200 upside on your renovated units. Now, to go a bit more into detail, Pleasant Creek, already mentioned in the previous slide, located right across the street from Riverbend. Currently, one of the best properties in the market. They're proving out the renovation upside, asking higher rents than us, and you can clearly see the path to growth here. Now, next slide, please. Ventura Landing, similar story here. This property is located less than 10 miles away from the property. Again, proving out the renovation upside. As you can see, they're asking higher rents than us on smaller units. And again, our property can so clearly be the best property in the area. Now I'll pass it back to Farhan.
Cool. Thanks, Oleg. Good job. Okay, so I want to repeat a little bit of what Oleg's saying over there is that there's eight properties over 100 units in Lancaster. Almost all of them, 7 out of 8 were built in the 1980s, and this property has the lowest rents in the submarket, and it is not because of the property. It is because of the strategy of the owner. And so, I want to go into why this deal is kind of a perfect deal for a Tryon renovation. So I can tell you, I'm going on 12 years at Tryon. You start to see patterns over and over, and we like submarkets like these. And it's common in our history that we go into a neighborhood that we haven't seen a lot of creative renovation strategies, and we implement them quickly and become the best property in the submarket. I am so excited to bring the Tryon Reno to Riverbend and to this submarket. I think it's really going to pop in a neighborhood where no one has done anything like this. This asset has that execution written all over it. The property, here are some interior renos. The property has large units, in some cases 2-story townhomes, in other cases 16-foot high ceilings in the bedroom. Some of the best floor plans in the submarket. It doesn't make sense that they're currently being rented out as some of the lowest, and we're going to change that pretty quickly. Now, our plan is to go in, we're going to cure deferred maintenance, we're going to enhance the curb appeal, we're going to implement professional management practices, and we're going to renovate 20% of the units. Since there is significant upside via curing loss to lease, we can prove out an upside play while leaving 80% of the renovations to the next buyer and still make a fantastic return for Tryon and Tryon's investors. This will make the pool of buyers much larger, and that's important when you go to exit here. Anyone from a family office, a high net worth, syndicator, private equity, or another Tryon could potentially buy this deal on the exit, and we want to make sure we leave enough meat on the bone so that the exit will be easy to execute. Now, a little bit more about the asset. The building was built in the 1980s. Which we love. Buildings in the 1980s are far superior than buildings in the 1970s when it comes to systems and how they were built. It is 471 units. We can hire a full-time team on site, probably roughly around 9 people to help us execute on our business plan. It's situated on 28 acres and feels very good, from the landscaping to the creek behind the property. It really is a beautiful property. And the floor plans, as I touched on earlier, really make it. 62% of the units are 2-bedroom units. Every unit has a washer dryer hookup, but no machines. We aren't underwriting any income from those machines, but we probably should be, and we will definitely make income from adding those machines in. And while the renovation upside is clear, to have such clear upside and execution, but also have a strong going in yield, strong basis, I keep on repeating, is just fantastic. I'm just so excited about it here, and what makes this deal special. And so I'm going to pass it back to Oleg to tell you about what he has seen kind of on the sales comp side and how Riverbend compares on a basis and yield perspective.
Thanks, Farhan. So, like we already talked about a bit in this presentation, this year alone, we have analyzed 106 deals in the entire Dallas market. So what this table represents is deals that have closed or are currently under contract in the entire Dallas market. Like we already mentioned, we're buying this property for almost mid 5% going in cap rate. As you can see here at the bottom, on average, the average going cap rate on deals that have closed or are currently under contract is 4.5. But what's even more compelling, I think, is the yield. So if we were to renovate 100% of the units and experience no rent growth, our return on cost, yield on cost is 7%, to be exact, 7.04%. If you see right here, the average return on cost is 5.25. I mean, that's a huge difference. You know, like Farhan mentioned, I'm underwriting deals in Dallas, Fort Worth every single day in the weeds, and I haven't seen anything remotely to a 7% yield on cost. not a single property has reached a 7% yield on cost, and only a handful of properties that I see have reached over 6%, let alone 7%. Now, this is the entire Dallas market. Let's talk about what's happening in the immediate pocket. So first, let's talk about properties that have traded last year. I already touched on one of the properties in the rent comp section. Pleasant Creek, number 4 on this list. Again, located right across the street. One of the best properties from a rent comp perspective, but also one of the best sales comps. As you can see, last year, in August of last year, it sold for $175 per square foot. The Meadows, number 3 on this list, also across the street, sold for $177 per square foot. We're buying this deal for $133 per square foot. I mean, that's a huge difference. So that was last year. Now, this year, there are currently 2 properties under contract. First one, Rolling Hills, number 6 on this list. It's currently under contract. It's located less than 10 minutes away. Very comparable asset and obviously location. It's currently under contract for $155 per square foot. We've walked it. We walked the exterior and interior units, and it definitely needs some work. So that's a pretty compelling number. Now, the second one, number 7, the Monet. This one is a bit further away. It's located 15 to 20 minutes away west of Lancaster in a city called Duncanville. Duncanville as a whole is an inferior market. It has lower demos, lower median incomes. There's a higher concentration of apartments and retail. And it's just an overall inferior pocket and inferior product, while it's currently under contract for a super high price per square foot number of $179. Again, we're at $133. Lastly, on this list, number 5, Candlelight Park. So this property traded this year in March at $141 per square foot. We've driven this property several times when we've flown out to see Riverbend and Dallas. And this property is definitely a way inferior product than ours, and needs a lot of work on the exterior, has a lot of deferred maintenance. The units are inferior. So the fact that it traded for a $141 is very good data. So now I'm going to pass it on back to Farhan.
Yeah, and just to keep in mind, these are value add deals. Pleasant Creek across the street that bought for $175 a foot. They're putting, we know the owners there, they're putting $17,000 a door. And that deal has been shopped off market. And they're going to be in it for north of 200 a square foot while we're going in at 130. It's just so compelling. And for all the boxes to be checked, it's we're excited about that. So I'm going to talk last about the location. Max touched on the strength of Dallas. I'm going to talk a little bit more about the immediate location. And although not integral to our business plan, this feels like what could be a very high growth location. We have long chased workforce housing deals in high industrial growth areas. These areas tend to have more affordable housing units, which make it hard for developers to pencil new construction and limit supply. For example, there's no deals under construction in Lancaster and neighboring DeSoto, Duncanville, although there is a lot of warehouse growth. And so due to the country's e-commerce growth, major retailers are expanding their warehouse in these locations and increasing pay to coveted warehouse employees. Growing industrial footprint equates to job and population growth, and ultimately equates to multifamily growth. We've seen it time and time again. In this market alone, there's over 73 million square feet of existing industrial space and 9 million square feet under construction. We believe that is roughly 4,500 jobs and potential new residents for a Riverbend community. In that same radius, as I said before, there are no multifamily units under construction. This is basic supply and demand. The employers in the area with warehouse space have been very impressive. And I would love to take any of you guys for a drive here, because I think driving this submarket is so interesting, because you can see the growth of how warehouses have come in, how national institutions have come in, how they've grown on neighboring pieces of land, and how they continue to grow. warehouse, while at the same time, no multifamily is coming in. It's very, very interesting. The employers in the area are very impressive. Walmart, Wayfair, Quaker, Amazon, Smucklers, Procter & Gamble, Whirlpool, all have added 1 million square feet of warehouse in the past 10 years in this area. Kohl's, Home Depot, BMW, PepsiCo, Unilever all have significant distribution centers, and my guess would be that they continue to expand based on what we've seen when we're out there. These companies are attracted to the open land, which is located in the south, access to the inland port, which comprises about 17,000 employees, proximity to the UP Dallas Intermodal Facility terminal, which is where the freight meets the railroads. And there's only maybe a dozen across the country of these type of locations, only about 3 miles from the subject property, and access to the majority of the country, which can be reached via truck or train within 36 hours. The area has doubled its industrial supply since 2016 and isn't showing any signs of slowdown. Now, this slide here is where we talk about the supply. You can see it's a lot of the supply is kind of coming into the north in the higher income areas of Plano, Allen, McKinney. This is maybe the most supply constrained submarket in the Dallas market in general. And ultimately it's good. The lack of supply in the immediate area, the growth story via the industrial. Don't forget the in-place caps and the pro forma caps. When they come together, that makes for a really good deal. And we'd love to have you guys as partners on this deal, investing with us. So I'm going to send it back to Andrew to wrap it up, and then we'll go into some Q&A. Go for it, Andrew.
Great. Yeah, thanks, Farhan. Great job, Oleg and Farhan. Yeah, so here's just another snapshot of kind of the basic deal metrics. One thing that I'm not sure if we should, but this deal will kick off some cash flow throughout the holding period. I believe the average cash on cash throughout the holding period is about 6%. So I know some of our investors, historically, we've done some pretty high octane value add that had not cash flowed for about 18 to 24 months. This deal does anticipate to throw off cash flow throughout the holding period. Yeah, but just to summarize, great price per unit, great going in yield, limited supply, growing demand of multifamily. So it really has fundamentals that make us very excited. Next slide, please. So this is just an overview of our fees and promote structure. Our fees are pretty much typically right in line with industry standards. 1% acquisition fee goes to the acquisition team. The lender fee, 0.75%, mortgage origination fee. The construction management fee, that's 5% of the CapEx costs. And then the asset management fee. The equity placement fee, that is a placeholder. There's an institution that we're working with that's considering a $7 to $10 million investment. So basically, that's a placeholder for their fees if they are to come in. It's possible, but that could get pulled out if they end up not moving forward. And one other thing I do want to highlight is the waterfall on this deal. So we structured the waterfall to bet on the deal ourselves as a sponsor. So you see here, the first hurdle is an 8% preferred return. Then it is a return of capital. Then we get 20%, you get 80%, up to a 15 IRR. Then over a 15, you get 70, we get 30. And over a 20, you get 60, we get 40. So there is no manager catch up on this deal. Many of the deals we've structured over the years, as I'm sure many of our existing investors know, it's a 75-25 split after an 8 with the manager catch up that catches us up. So basically, as long as the deal hits a 10.67 IRR, we would get 20% of the profits. No catch up, but we're betting that this deal is going to outperform by structuring the promote this way. Next slide, please. So we're betting on the deal. So here's just a couple of deal highlights we'll leave you guys with. I know we've kind of touched on all this, but low basis, 117,000 a unit entry point into a growing market. A year ago, that was just never have been believable. Strong going in yield. We're getting it at an in-place 5.5 cap. This area is a huge industrial hub. There's tremendous amount of industrial growth there, impressive employers. And with that, you have wage growth, you have job growth, but there's very limited multifamily supply. So that creates a very conducive environment for rent growth. And then lack of new inventory as well. So with that, we will take questions. Actually, before that, we do plan tentatively on being at the property. And I know you guys are all located throughout the United States, but if any of you are local to Dallas, or if you're interested in potentially flying in and doing a site visit, it will tentatively be there. It looks like August 16th, which is a Wednesday. So feel free to email me, Farhan, or Oleg if you're interested in potentially touring through the asset on that date. So with that, we'll go ahead and start with some Q&A. We will answer any and all questions. So if you have a question, just enter it there in the Q&A box and we'll take it from there. The first question, is this asset going to be in Fund 4? Yes, Fund 4 will be investing in this asset. The funds basically will invest in 15 to 20 different assets with similar profiles to this. Okay. If cap rate is 6% or 6.5% at exit, what would returns be? Farhan?
Yeah, so I'd have to double check, but I think at 6.5, I think it's a 14%. And going up the sensitivity, if it were a 5% exit, which we actually think it would be a 5% exit, especially with 80% left, it's more of a 24 to 25. So, at a 6.5% exit, which we haven't seen in this market, to still have a 14% deal level is pretty strong. And I believe that sensitivity spreadsheet is in the investment memos as well. That I think.
Yeah, so it actually, we had to limit the slides for this presentation, but in the PPM, there is a sensitivity analysis that you guys can review. Is 20% renovation the target, or is it a higher percent? Or is a higher percent the ultimate goal? Will it depend on how long you hold the asset?
Yeah, 20% is the target. I think if 3 years comes by and it seems like it's not a good time to sell, I think we'd probably end up doing more renovations, but 20% is the target, 20% is the plan. If in 3 years the market is stronger, there are more buyers in the market, and we can exit, we will stick to 20% and exit in 3 years.
Farhan, do you need architectural, landscape, or interior support as you reposition this property?
The way it was asked, I thought you were going to ask for my house. I do need it for my house. We have vendors we work with actually in the Southeast who are based in this market who are doing those who are working on those renovations plans.
Why are competitive buyers less interested in this asset?
It's hard to say. This asset was off market. I think the Rolling Hills deal was on market. I believe there was about a dozen offers on that market. But in general, I think South Dallas. When you talk about Dallas, everyone flocks toward the north, but it kind of looks at South Dallas as like an inferior pocket. We see something different where immediate South Dallas can be rough. You go a little bit further down and we see that the warehouse growth. One thing we didn't say is 70% of the residential here is single family residential, big lots, $400,000 single family homes. This area feels really good, but can be sometimes lumped in with kind of a South Dallas location. Now, I do think it would have really strong demand if it hit the market today, and likely have a potential to go for a higher price than what we're putting it under, what we have it under contract for today.
Great. It looks like we have two questions asking to describe the debt structure.
Sure. Shark, Max, you want to go with that?
Sure. Yes, we're going with a relationship lender of ours. They are actually lending, which a lot of banks and creditors are not lending. Agencies, Fannie and Freddie, have been kind of the go-to this year because, again, a lot of people just aren't lending, but we're going with an existing lender of ours. We've borrowed several loans from them, paid them all off. They've been happy with our execution. They see how we execute, so they know that we're not just going to sit on our hands and wait for the market to go up and burn loss to lease. We're actually going to go in, renovate, and create value. So they are lending to us actually at lower than what they lend nationally to new borrowers. Our spread is approximately 200 and it's over the 3-year swap, and it's 65% loan to cost. And I want to say the 3-year for Hans, what, about 4% right now? 3.9?
Yeah, but it's over the swap, so it's the swap is at probably 4.2 today.
Okay. So and the loan is fixed. Unfortunately, we can't rate lock before because it's a swap based loan, but it will be fixed for a little over 6%. And then we'll likely refinance it in a couple of years, even though that's not in the model. We want to be conservative. We'll refi it in a couple of years. Farhan, what is the first extension test? I don't remember off the top of my head. Is it 8.5 debt yield, 9 debt yield?
So we need 120 DSCR on a 6.75 interest rate.
Yeah.
Which we should meet pretty easily. So
Yeah.
it's the loan is a 3 + 1 + 1. And that test that Farhan just mentioned is for the first extension.
It's essentially an 8.75 debt yield that you're mentioning also.
Moving on, what is the timing? What is the timing on closing this deal? So we're currently set to close September 6th. So we'll likely call capital, the last week of August. Can you show the annual cash on cash rate? Yes. If this is in the PPM and we're targeting year 1, 4.34, year 2, 6.34, year 3, 7.04. Have you done a sensitivity analysis on rates, occupancy, etc.?
We have our rate is fixed, so we don't need to worry about that. But we will play with the cap rates. And then on occupancy, I think we underwrote very conservatively. Farhan, what's our year 1 occupancy, like 8 or 9? I'm sorry, vacancy.
Yeah, year one, we're at 90% effective occupancy.
Pretty conservative.
What would you say are the biggest downside risks on this deal?
I would say the biggest downside risk is more macro issues. As you could see by the sales comp set, our basis is very low, so our downside risk is protected. You've got supply coming online, as we've discussed, but there's a lot of in-migration. So I suppose a risk is the in-migration doesn't actually continue, but that would be surprising, or maybe it does continue, but it does not flow into our submarket, even though our submarket doesn't have much supply. But that's always out there. So, and then we are doing a heavy reno. It's a 1980s asset, and that's definitely a risk. So you're opening up walls and you're doing all that stuff. So I would say physical plant and vintage is a risk. Cost overruns, surprises.
Do we plan on doing a cost segregation study?
Yes.
Yes. This is Trion's first acquisition in Texas. Yes, this is our first acquisition in Texas. As Oleg mentioned, this is the 106th deal in the greater Dallas market that we've underwritten this year. So, we've been tracking this market for over 2 years, and we think this is the perfect entry point for us.
I'll also add to that is our director of ops worked out of Dallas, Texas, knows the market really well. We plan to retain staff on site, and then we have vendors who work with us in the Southeast who are actually based out of Texas. And so even though it is our first acquisition in the market, we are situated well to hit the ground running.
When I moved to Miami and we started in the Southeast, that was really entering a new region of the country, which was much more challenging than entering Dallas now, because in the Southeast, we're cross country, didn't have a list of vendors or any of that. And Dallas is really a minor extension of the Southeast.
Does Fund 4 get the same waterfall structure as this deal? The answer is no. The fund has a separate waterfall structure. I'm happy to share that. Just send an email if anybody has questions. This is not an opportunity zone project. Somebody asked that. We talked about debt. How do you compare investing in this property alone versus investing in fund? How long is the hold period for this? So for this property, the projected hold period is 3 years. For the fund, so it's really like investing in this deal is a good analogy is you're picking a stock versus investing in the mutual fund. So if you invest in an individual deal, I mean, we like this deal, so we think this is a good one to invest in, but you are fully concentrated in this asset. If you invest in a fund, you're going to be spread over 15 to 20 assets in diverse geographic locations. So by nature, the fund is going to be lower risk because it's diversified. We recently launched Fund 4. So we'll be raising for about another 14 months and allocating over another probably 2-ish years. So the fund will have a longer hold period than an individual deal was, just because you're allocating over a period of time. Are all the units occupied? What are the social status and age status of the tenant base?
I think we'd rather not talk about social status, age status here. Max, do you agree with that?
We don't even know. I mean, I don't think we can. And we're able to answer that question. I don't know what the ages of the people are. Social status. We know where they work. It's a lot of like service-based employees. Farhan?
Yeah, and we have an average demo of what we were able to get, and it was close to 48,000 per unit. But I can't really speak to the age too much. What was the second part of that question, Andrew?
I mean, that's this. Are all the units occupied? So what's current occupancy, like 90?
Yeah, well, like current occupancy is probably around 96.
Yeah, it is.
Okay, great. We already spoke to the debt. I hear government is going to cap the rents. Any thoughts on that?
No,
I don't believe
that's
there's
not going to
risk of
happen
that.
in Texas.
It's part of the reason. Yeah, part of the reason we look in Texas and we're moving out towards these type of markets.
Is the plan to front load the renos or execute steady throughout the hold period? Is there a
Steady
scenario where 2025 exit makes sense?
Yeah, there's definitely a scenario where 2025 exit makes sense. We'll definitely sell at a point when we think the market is heating up and we're seeing more buyers in the market. I think most likely it'll probably be a 3-year hold. And we will do steady renos throughout. The first year we're going to be spending doing the exterior renovation. And so we've modeled less renovations the first year. We'll really push those renovations into year 2 and year 3 after we've done a lift on the exterior, so that a new resident can see the full package.
Did you say there may be preferred equity going in? There is no preferred equity on this deal. What is your minimum investment? Our minimum investment is $50,000. Do you share your underwriting plan? Yes, we're happy to. The PPM's got pretty thorough underwriting metrics, but if you want to dive into the model, we're happy to send that as well. As you did when you entered Colorado, will you be using third-party property management? No, we're going to manage this property ourselves. When we entered Colorado, the thought was we'll outsource management until we're able to build up a large enough portfolio that it makes sense to bring it in-house. And what we found was we still did a lot of property management work, even though we were outsourcing it. So we think it's best suited and most accretive to the investment to keep management in-house, even though we're entering a new market. Unfortunately, this property has the scale as well. It's not, if we were buying a 70-unit property in Dallas, it may not make sense, but this is a fairly large property, so it has the scale to have management in-house.
We believe our property management is really, best in class, and that we can be more hands-on and we can push our business plan execution. And like I said before, we have the vendor relationships in this market, and that is kind of a big hurdle when entering a new market.
The minimum investment for Fund 4 is $50,000. So direct deals and the funds are each $50,000. Are there any fee incentives for larger amounts? Reach out to us directly. What is the closest big industry near the property? I mean, all
Logistics.
The industrial.
Logistics,
Yeah. How many unit turns do you expect per month? Is that consistent with the historical unit turns? It's a good question.
Yeah, it's roughly 3. If we were going full blown, we could definitely do 10, 12 per month, but we're underwriting and planning 3 per month. And potentially that could be, we can go faster than that, but I think we're going to pick our spots.
Awesome. That is 34 questions answered. If anyone has any other questions, please ask now. If you didn't get a chance to ask a question, feel free to reach out to Oleg, Farhan, or myself, and we'll do our best.
Thanks, everyone.
Thanks, guys. That was fun.
Thanks, guys.
Yeah, sure.